What's up, everyone? My name is Ali. Welcome back to my world of stocks, and welcome back to my 3 stocks on sale series for the month of August 2023. In each episode, I try to find you guys 3 new stocks that I feel are potentially trading on sale at today's prices for the long term. And to make things a little more fun and interesting, I specifically try to choose one low risk, one medium risk, and one high risk option for added variety. As always though, just please keep in mind that, stocks are relatively higher risk right now, especially in this economy. So as always, just please do your own research and make your own decisions. I'm not telling you how to spend your money. I'm just sharing my own thoughts and my own opinions. But if you appreciate that and you want to support the channel, then please consider supporting me over on Patreon, where you not only help keep this channel alive, but you also get some cool perks in return, like access to our community Discord, where you can talk with like-minded investors about stocks at all times, and it's a ton of fun, and I would love to see you on there. But with all that said, we got 3 very interesting stocks to run through here today, so let's go ahead and jump into them. And by the way, one of the stocks that we'll be talking about today is actually a brand new addition to my portfolio that I just started buying today, so that's gonna be a lot of fun too. So let's not waste any time, let's go ahead and jump straight into the list. Alright, and starting first here with our lowest risk option, I continue to think that Google is the best all-around low-risk giant stock out there, safest one I would say, but I talk about them in so many of my videos that for this month, I'm going to switch it up and I'm going to go with what is probably the second best giant at today's prices right now. And that is the e-commerce giant Amazon, ticker symbol AMZN, which there are countless reasons to hold in almost anyone's portfolio. But for the sake of keeping this video short and to the point, I'm just going to give you a few quick reasons that have to do specifically with where the stock is trading right now. And reason number 1 is that while they are just as large and dominant and reliable as other behemoths like Google, Microsoft, or Apple, their stock is still lingering lower from the top than all 3 of those. Google, for example, is only down 13%, while Microsoft is only down 8%, and Apple is basically trading right near an all-time high. However, Amazon is actually down around 30% from the top. That's a very significant dip. And again, I still think that Google is the most attractive overall as they carry the cheapest valuation of the bunch, but Amazon isn't too far behind at the second cheapest PEG ratio of the list. Plus, what the Amazon bears always refuse to acknowledge is that Amazon doesn't really care about profits right now. They're the only company of the big giants that has never really cared about that metric. I mean, just look at how big their gap is from sales to profits. Last year, they actually lost money on the bottom line, and that's after doing over $500 billion in sales in just a single year, and they still lost money on the bottom line. That's, crazy numbers that we're talking about here. And that's what the bears always argue against them, is their lack of huge profitability, but they completely ignore that the gigantic amount of sales that are still somehow growing at a double-digit rate can still be tapped into over time. And it shows how all that Amazon really cares about right now is growing their business as large and as dominant as humanly possible. And then when that growth finally starts to dissipate, that's when they can start focusing on profitability and converting, some of that giant amount of sales into some profits. But for now, it's just not necessary. And as a shareholder myself, I prefer them to keep reinvesting back into the business. And by the way, that huge performance on the top line is why they have such a cheap price to sales ratio of only around 2. Google, on the other hand, is above 5, Apple is above 8, and Microsoft is above 10. And so I think Amazon stock is pretty much always a pickup, but I feel that even more strongly right now since they're going to be reporting second quarter earnings this week. First of all, most companies have been easily beating earnings estimates this quarter, which is more strongly reflected in tech companies and is also being led by consumer discretionary according to analysis from Bank of America. Well, if consumer discretionary is up, then that means that consumers have been spending money. And if consumers have been spending money, then you can be sure that they've been shopping on Amazon too, because it's the leading, retail giant out there. Which, by the way, Amazon just held their Prime Day event, and once again, it broke new record highs with US shoppers alone spending almost $13 billion in just a couple days. Now, granted, Prime Day happened in July, which means that it took place during the third quarter, but I still think that it's a sign that consumer spending has been strong, and I also think that management will talk about the success of Prime Day during the report and on the earnings call anyway, which could, help the stock as well. And even if earnings are bad and the stock falls, guys, that'll just be another buying opportunity. The way I see it, Amazon stock is down 30% right now. That's a huge dip. So if earnings are strong, the stock will rise. But if earnings are bad, the stock could potentially fall even more than what is already a 30% drop. So what else do you really want from this? I mean, I think the stock is a buy before earnings, and if it goes up, great. And if the stock falls, it's an even bigger buy. I love to do most of my buying when stocks are actually going down. So I can't really see a way of going wrong with this, because long term, I still think that Amazon is going to be a winner regardless. So, I like it here, and that's just my opinion, guys. All right, now moving on though to our medium risk option this month, I'm going with the giant dividend payer in the telecommunications king, Verizon, ticker symbol VZ, who admittedly is more of a high risk stock than a medium risk one, but I have an even higher risk stock for number 3, so I kind of had to put it here. But look, even though it's riskier than most out there, I'm still buying the stock in very small amounts myself, because from the top, it has now lost close to half its entire value, leaving it trading at the lowest prices that we've seen, not just since the gigantic 2020 stock market crash, but it's at the lowest prices in over a decade, guys. That's a pretty big deal. And just as importantly, the dividend has now reached a monumental yield of close to 8%, with still a pretty good payout ratio and almost 2 decades of consecutive growth. And that dividend, by the way, is also at the highest level that I've ever seen in the stock's history. So needless to say, it is very attractive at this point. The problem, however, is that Wall Street doesn't seem to think that the dividend is very safe here, and they do have some very good reasons for worrying about that. For one, Verizon's business just isn't really growing much anymore. And after the huge amounts of money that they've been spending to expand 5G and fiber internet, they're being left with huge amounts of debt, which is hard to pay back when you're not really growing so much, and thus funds, could potentially be taken away from the dividend in order to cover a lot of that debt. And when you look at the most recently reported quarter, you can really see how even competitive pressure from AT&T and T-Mobile is also weighing heavily on them as they continue to lose thousands of wireless customers every quarter. Now, the reason why I'm choosing to buy the stock anyway, though, is because I feel that it's being oversold at this point for what is still really the best player in their respective market. First of all, those sub-losses are being heavily offset by actual gains in business and internet. And when you think of business, there's a reason why Verizon alone controls almost half the entire market. It's because of their vastly superior quality that is unmatched, since businesses really have more money to spend, and thus they can care more about quality than the average consumer. Well, when it comes to quality, Verizon continues to receive the highest score in every single region they operate in across all study factors, where they've also received the most JD Power awards for network quality at a record-breaking 31 times in a row, and have now earned close to 200 of those network quality awards in just the past 20 years alone, which is also the most of any wireless provider in history. And because of all this, despite the losses in consumer wireless and despite the lack of overall revenue growth, their free cash flow profits have actually increased from $7.2 billion in the first half of last year to $8 billion this year. For context, the dividend is only $5.5 billion. So in my opinion, the dividend is still easily covered even with how much money they spend. I mean, it was $18 billion of operating cash flow with over $10 billion going to capital expenditures, and they still had more than enough money to cover the dividend. And it also leaves, billions left over that can be used to pay debt. In my opinion, I think Wall Street is selling the stock more so perhaps because of the high interest rate environment that we're in right now, because it's making their debt and any future debt more expensive. But if Verizon can survive the storm right now, and if they don't cut the dividend, I mean, this is a stock that could soar in the future once interest rates start coming down, and I've already locked in almost an 8% dividend. I mean, that's a very attractive proposition. Another concern, though, or at least something that I always hear the bears say, is again goes back to that idea of just too much competition for Verizon, too much heavy competition from AT&T and T-Mobile, and hey, there could even be more competition on the horizon from giants like Amazon based on new rumors. But I guess my response to that whole thing would be that, well, first of all, Amazon, that's still kind of a wait and see situation. A lot of it is speculation. And even if they did enter the market, I still think that that would probably benefit Amazon more than it would hurt Verizon, which, by the way, just kind of makes Amazon stock even more of a buy than I already said it was in this video. But just for Verizon alone, I mean, guys, this is a telecom market here that is basically dominated by just 3 companies, with Verizon clearly being the quality leader of it. Yet the stock is so cheap right now that it's literally trading over 60% cheaper than the sector on a PE ratio basis. So how much competition should I really be worried about? I mean, imagine if the automotive market only had 3 players, or if there were only 3 airlines out there, or only 3 makeup brands, or 3 video game companies. I mean, the fact that we rely more heavily on smartphones and internet than probably anything else in the world, I mean, I really feel like, at least in developed countries, I would say most people have a phone and have internet access. And the fact that there's only like 3 major companies dominating that market, I know internet there's more companies, but still, I mean, not too many own the majority of it, but especially in wireless, I mean, 3 real giant companies here dominating that market. I think that's pretty crazy, and I really don't think that competition is the biggest threat to be worrying about. I actually think interest rates is the biggest threat to Verizon stock right now because of their massive debt, because of the fact that they don't really have the growth to match that. So, the real question I just think is, can Verizon hold on long enough to survive this high interest rate environment? And can the business part of their business make up for the struggling consumer part, buy them enough time to really turn around that part of their business that is struggling? And then, potentially coming out of all this, you could be left with a great value oriented, super high dividend stock with a really high yield locked in. Potentially it could still be a value trap. Time will tell, and I do understand that argument. It could be a value trap, but I don't really think it will be. But that's just my opinion. Alright guys, that's going to leave us now with the third and final stock of the list, which is also our highest risk option. And this month, I'm going with a brand new stock that I just added to my portfolio for the first time ever, and that is the automotive giant General Motors, ticker symbol GM. Now, before we go any further, let me just get a couple things out of the way. I fully acknowledge how risky of a stock this is, having now fallen by close to half its value and trading at about the same price it did a whole decade ago, which is very similar to Verizon in that sense. But anytime it drops below 40, I just feel like that's a relatively safe place to jump in on the stock. And either way, I'm only buying a very small amount at today's prices of around $38 a share that I can easily add to over time if it continues to fall and I need to lower my cost basis. But at these levels, you're already talking about a dirt cheap valuation here for one of the market leaders that is actually trading more than 60% cheaper than the sector on a PE basis. Again, just like Verizon. Now, they don't pay the same gigantic dividend as Verizon. It's only about a 1% yield, but that's not at all my reason for buying the stock anyway, or any part of my investing thesis. That's just like a nice little added bonus. Now, you guys know that I'm also heavily invested in Tesla stock, but unlike some people, I actually think that the EV and autonomous driving markets will be so gigantically large that they'll be able to support multiple players in the space. In fact, I was just talking about how rare it is for only 3 companies to dominate an entire market, like in the case of, Verizon. Well, in the automotive market, there's hundreds of different brands, and if you think Tesla is going to put all of them out of business, you're delusional. Some legacy players will survive the transition to EVs, and I think GM has a better shot than most. First of all, GM has very popular brands under their umbrella, especially through Chevrolet, where they have the Silverado pickup truck or the Camaro muscle car, both of which are getting electric versions, by the way. The electric Silverado, for example, is even set to have nearly 40% more range than both the Ford F-150 Lightning and the Rivian R1T. And in total, GM is actually spending $35 billion on electrifying their vehicles through 2025, while also building 4 battery plants just in the US alone. By the way, one of the biggest reasons why Tesla is so much better and more profitable at making EVs than the competition has a lot to do with battery technology and manufacturing. So GM building their own plants, even through partnerships, is a huge step in the right direction. As such, GM is aiming to make their EVs profitable by 2025, with also the help of Washington's subsidies. And to further hammer down my point that there can be multiple players in the space, GM's own CEO even met with Elon Musk on Twitter Spaces to announce that they'll be using Tesla's charging standard, which mutually benefits both companies. And while GM's financials have been struggling for years, the fact is that they still managed to post a record high in sales last year, and they even reported an amazing quarter last week, with sales rising 25% and net income 51%. Obviously, that growth is not going to continue, and this is mostly a flat type of business that is currently going through some, very large swings both up and down. But my point is that the stock is trading as if they're going to maybe one day disappear. And yet I actually think that they're doing a pretty good job of adapting, which is in large part thanks to a 3-pronged attack that is actually working. One part is to cater to higher margin trucks and SUVs, which they're doing a great job of with their GMC and Chevy sub-brands. Another part is to cater to the best-selling segment of smaller SUVs, which they're also doing a great job of with their Chevy brand controlling a quarter of the entire market, which is the highest it's been since 2007. And then the final piece is to keep investing in electric vehicles, which they're clearly doing as well, and that'll slowly ramp up over time. So you add all of this up, and I just think you're really left here with a pretty decent turnaround value play here for the future. And sure, just like Verizon, these could end up being value traps, but the stocks are just down so much already, and I really don't think that their businesses are ever going to go away. So I just feel like, over the long term, these prices have to be higher. I just think they're going to perform better over time. So, time will tell, but, those are my opinions, guys. I'd love to hear what you all have to say down below. What do you think about these stocks? Any stocks I left off that you think should have made it in this month's episode? I'd love to hear your thoughts on that too. But thank you so much for stopping by, everyone. I really appreciate all your support, and I will catch you in the next video. Take care, everybody. Bye-bye.